Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris Rapeseed. We've had two patterns here, two completed patterns that have been the main influence on this market since as far back as summer last year. The first pattern is an overextension of the bright red neckline, currently at 449, of the May to August 2025 Head and Shoulders continuation pattern. The bright red neckline also shows up in the second pattern. In this case, it acts as a lower trend line, together with the nearby bright green upper trend line, that together formed a shallow July to October descending wedge pattern. We had a break higher over this pattern in October last year, a good break higher, or so it seemed at the time, but instead it turned out to be a false break higher, failing twice in late October and again in late November. At the dark blue overhead neckline extension, which is currently at 484 even, and that's of the August to September reverse head and shoulders, September 2024 reverse head and shoulders bottom, and forming a small double top in the process. The downside primary and secondary targets for this pattern were duly reached in December last year. Now, prices overshot the targets on the downside, dropping down below the bright red neckline extension. But this, along with the 50% absolute Fibonacci line at 445.5, eroded the bearish pressure, such that the very start of this year has been the lowest we have seen in this market since March 2024. We have since risen sharply, and this brings to mind the pattern the whole of the November 25 today action has created, a diving board pattern, where from a fairly flat area the market dives down as if into a swimming pool and then pulls up and out of the pool. We have pulled up and out of the pool and have actually reached the pullback target area in the 472.5 area yesterday as prices broke up over the green short medium moving average, currently at 467.75, and the mauve medium moving average, currently at 469.25. But we've gotten capped by the overhead flatlining long moving average, currently 476 even. Now, a diving board pattern is a bullish reversal pattern, so the opportunity for higher prices is still there and something to watch out for. The recent action also ties in with another feature I pointed out 5 weeks ago. I said, and this is a long quote I'm afraid, and I quote, above the market we have a possible bow tie formation made up from three moving averages. They are the short moving average, currently at 461 even, green short medium moving average, and the mauve medium moving average. This possible bow tie formation happened this past Monday, the 15th of December, and it's worth discussing. Thus, the theory indicates that after such a crossover, some 15 to 20 sessions after it, we have one or more of the following: a change in trend, a reinforcement of an existing trend, and volatility. This is complicated somewhat. We have a holiday period coming up, so it is not a straight 3 to 4 week run after. Instead, if we follow the count accurately, it will be between the 7th and the 14th of January 2026. End of quote. We already had the big dip, and the move up started on the 5th of January, so close enough, and between the 7th to the 14th of January we had a solid, if unspectacular, move higher, which verifies this pattern. The question now is what's next? Well, the overhead gold long moving average is the immediate obstacle, and then beyond this, the dark blue neckline extension. I would say they are both somewhat significant, if not formidable, with a more heavier emphasis on the dark blue neckline above. Looking below, well, we could try again, going lower again, but the market was down there recently and didn't like it. However, if we did try lower, the key will be the 50% absolute Fibonacci line. Winnipeg Canola. The key recent pattern here had been the fairly obvious bright red late June to late October bear channel. 12 weeks ago, the market broke higher over the bright red upper bear channel line, as well as pushing up over the 2021 low at 629.5, plus the lesser Fibonacci line at 632.90, and then challenging and stabilizing over the bright green short medium moving average, currently at 635.10, before 9 weeks ago making a small gapping move higher, since filled in over the significant combination of the June 21 low at 655.90 and the 50% Fibonacci line for 2025 at 655.70. Prices continued higher, but then, unsurprisingly, ran into trouble around the slowly declining mauve medium moving average, currently 634.70, and the extraordinary flatlining gold long moving average, and that's currently at 663.5. Further above is what may be in some ways the additional cause to this halt, the significant bright green April to August head and shoulders neckline, which is currently at 685.40. Thus we ended up and out of the bear channel and almost, though not quite, seemed to start to form a small October to date based bull channel. However, the bullishness faded under the capping pressure of the mauve medium and gold long moving averages, plus that 50% Fibonacci line for 2025 at 655.70. And 7 weeks ago prices turned lower, with a small November and early December based double top, with the market subsequently crashing down through all the previously mentioned levels. In the process, the primary target for the small double top at 641.40 was reached, as was the hardest to reach secondary target down at 630 even. 6 weeks ago I said, and I quote, "Whether this is a bearish half hesitation for potential down to even the 585 level, thus this would then be below the 50% absolute Fibonacci line at 606.90, and that would be one to watch." End of quote. Now, and I added to that 5 weeks ago the following, and I quote, "Now in truth I favoured the basing action idea here, but it looks like the 50% absolute Fibonacci line is not going to stop decline, in which case we would next be looking at congestion at 575 even. It all depends on the 606.90 50% absolute Fibonacci line. Can it hold?" End of quote. In truth, the 50% absolute Fibonacci line did not hold the market, but it did erode the bearishness enough that we formed a small double bottom over the end of December last year and the start of January this year. The move up since the formation of that small double bottom has reached up to both the primary and secondary targets topside. We have late last week pushed up over the green short medium moving average and mauve medium moving average combination, and up to test the same resistances that capped prices in late November last year, the 50% Fibonacci line of the 2025 move and the gold long moving average, and that's currently at 663.5. Will the market this time push up through these? Well, I'm not too sure, but we would next have resistance up at the bright green neckline of that April to August 2025 head and shoulders top, currently 685.40. Though I am still pondering how good any resistance up there might be. Bursa Malaysia crude palm oil. To start with, as I've done for most of last year, I'd recognise the wide congestion areas overhead between 44.08 to 45.59. We tried in mid-October last year to pierce it and failed, with prices punching down through the lower edge of this congestion, as well as most of the moving averages for quite some time. On the way down, prices dropped down through a wide congestion zone, made up from the 38.2% Fibonacci line of the May 20 to March 22 move, and the 50% Fibonacci line of the May 23 to December 24 move, both of them at the same 42.74 level. Then the 38.2% Fibonacci line of the July 19 to March 22 move at 42.39, and the July 23 high at 41.89, into a free area, where the market created a small diamond continuation pattern. More on that one shortly. You see, the recent overall pattern had been the dark blue mid-August to early October bearish Andrews pitchfork. This had been pretty good at leading prices lower until we reached 3 bands of congestion. The lesser Fibonacci line at 40.26, congestion at 39.86, and the February 2011 high at 39.53. I suppose in the big picture you could also include the bright red neckline extension that slashes across my daily chart of the late May to April 2024 small reverse head and shoulders bottom, which is currently at 38.33. I know the prior three eroded the bearishness of this market, so I suppose this one also played a small role of some form. Anyway, the move lower within the dark blue bearish Andrews picture was fine until two things occurred. The first is the construction of what we can see as a triple or even a quadruple bottom over the November to date period, though I am more inclined to look at it as a very complex reverse head and shoulders bottom. This is a subjective judgment on my part, I realise that. This pattern came of the previously mentioned November to early December diamond continuation pattern. The second occurrence happened this week, with prices breaking higher from this complex reverse head and shoulders bottom and punching up through the dark blue upper time, currently at 14.96 of the bearish Andrews pitchfork. The market's earlier actions precluded me finessing this to a shallower bearish shift pitchfork, so it is very much decision time on this breach higher, whether it remains a breach or a proper break, and the resultant downgrading of the dark blue bearish Andrews pitchfork and subsequent retirement. I'm not wholly keen on doing that just yet, as we have this wide overhead band of congestion previously mentioned between 41.89 to 42.74. And we seem to have gotten stuck under the mauve medium moving average at the moment, which is currently at 42.02. However, I do note that we have pushed up through the gold long moving average, which is currently at 41.54, though we have not as yet stabilized over it. My final point is a difficult one, and is to discuss whether the primary and secondary targets would be on the upside to the break above what I consider to be a complex reverse head and shoulders bottom. There is no easy neckline here, but I feel it would be suitable to look at the 4100 area as a suitable starting point. Hence, the primary target X would be in the 42.47 area, so not too far above, with a harder to reach secondary target X1 up in the 43.07 area. I'm not wholly in love with either of these two, but for now, they will do. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.